Good morning. Welcome back to a Market Monday. It's been a really busy couple weeks in the markets. A Fed rate hike, a much anticipated GDP report, and the busiest week of earnings seasons got the most headlines. There was even a surprise out of Washington, D.C. with the Schumer-Manchin agreement on a climate healthcare tax bill, and some inflation data that added to the evidence that inflation has certainly peaked. Stocks expressed approval of this news, securing its second straight solidly positive week. The S&P 500 index enjoyed its best month since November 2020 and its best July in over 80 years. Last week's gains were encouraging. Let's look at each piece of news individually. First, the Fed hinted at slowing the pace of interest rate hikes later this year. Whether markets may have gotten a little ahead of themselves remains to be seen, but in the past 6 weeks, nearly 0.75% has come out of the market's expectation for the peak Fed funds rates, the short-term rate controlled by the Fed. The inflation battle is far from over, but the market's reaction was certainly encouraging, and the Fed may be poised to surprise the market with a pause by year-end. Next, as we talked about last week, the first read on second quarter GDP revealed the U.S. economy contracted for the second straight quarter. With a strong, albeit slowing, job market and resilient consumer spending, we believe not enough sectors of the economy are contracting to qualify as an official recession. Evidence for things that typically don't happen in a recession are durable goods orders, high and not rolling over yet, travel and leisure companies beating earnings estimates and raising their outlooks, and the largest company in the world having its best quarter ever. Again, evidence that we don't believe we have been in a recession, but that's not to say we couldn't enter one in the future. If a recession does come, frankly, probably a 50-50 proposition for the first half of 2023, it will likely be mild. A mild recession was probably already priced in at the June stock market lows, suggesting June 16 may have marked the S&P 500's ultimate low. Capping off the busy week, the flurry of earnings reports demonstrated that corporate America has managed stiff headwinds very effectively. Given the slowing economy, intense cost pressures, and a strong U.S. dollar dampening profits from their overseas operations, a 6% year-over-year increase in S&P 500 earnings per share during the second quarter is quite impressive. Estimates for the second half of 22 and 23 have come down as expected, but with expectations so low, stocks generally rallied on results even as estimates were cut. As we see so often with investing, the uncertainty was worse than the actual event, in this case cutting earnings estimates. Once that actually happened, some of the uncertainty resolved, which markets generally appreciate. Looking ahead, August has historically been a weaker month for stocks, but consider that midterm election year lows, which typically come around this time of the calendar year for the S&P 500, have historically been followed by strong gains over the subsequent 12 months, on average over 30%. And some of the timeliest indicators of inflation, like commodity prices and various consumer and business surveys, indicate some cooling ahead, even if it may be a slow process. And lastly, market-based interest rates, those not controlled by the Fed, have come down quite a bit, supporting stock valuations. At the same time, geopolitical tensions are rising as House Speaker Nancy Pelosi visits Taiwan and the war in Ukraine continues. But we believe the combination of low valuations, lower interest rates, prospects for inflation reducing, and the possibility that the Fed signals a pause over the coming months tip the scales towards the bulls. The ride probably won't be smooth, but we believe long-term investors who stay the course won't have to wait too long to be rewarded for their patience. Thank you and have a great day.